Welcome to this new episode of our video course, Get Schooled in Finance. Today, we will discuss where to place your emergency fund, a crucial topic for intelligent financial management. We'll cover various options like checking accounts, savings accounts, short-term bonds, and money market ETFs. Stay with us until the end because I'll also reveal an interesting fact about one of these instruments. Let's start with the emergency fund. What is it? It's a reserve of money set aside to handle unforeseen situations, like car repairs, job loss, or other unexpected expenses. It's the second pillar of your financial strategy, essential for avoiding the need to liquidate your riskier investments hastily. Having an emergency fund gives you the peace of mind that you can handle life's unexpected challenges without having to dip into your long-term investments or take on debt. Where should you put this emergency fund? The simplest solution is a checking account. Yes, keeping the money there makes it easily accessible. Some checking accounts, like those from certain banks, even offer an interest rate of 4% on deposits. But be cautious, there are taxes to consider. For example, interest is taxed at 26%, and if the average balance exceeds $5,000, there's an annual fee of about $34. This means that while your money is safe and easily accessible, it's not necessarily growing significantly. However, the main advantage here is liquidity. You can access your funds immediately when you need them. Another option is a savings account. Technically, it's similar to a checking account but doesn't offer services like bill payments or withdrawals. It's like a piggy bank that gives you a higher interest rate. Here too, the interest is taxed at 26%, and there's a 0.2% fee on the balance at the end of the year. Savings accounts can be fixed or flexible. If you choose a fixed account, the money will be locked until the term ends. If you opt for a flexible account, you can withdraw the money if needed, but you'll lose the interest accrued up to that point. Savings accounts often offer higher interest rates compared to checking accounts, making them a better option for those who want their emergency fund to grow a bit while still being relatively accessible. Let's discuss the details of savings accounts a bit more. Some banks offer promotional rates for new accounts, so it's worth shopping around. For example, you might find a savings account offering a 2% promotional rate for the first 6 months. After that period, the rate might drop, but it's a good way to get some extra interest in the short term. However, always read the fine print. Some accounts require you to maintain a minimum balance to earn interest, and others might charge fees if you make more than a certain number of withdrawals per month. Understanding these terms can help you maximize your earnings while avoiding unnecessary fees. Let's move on to short-term bonds, like Treasury bills, T-bills. These are government securities that mature within a year and are taxed at 12.5%. If you need liquidity, you'll have to sell them, but be mindful of market fluctuations. T-bills are an interesting option because they are taxed less than savings accounts, but they can be less liquid if the market isn't favorable. The way T-bills work is straightforward. You buy them at a discount to their face value and then receive the full face value at maturity. For example, you might buy a $1,000 T-bill for $980, and when it matures, you get the full $1,000. The difference is your interest. One of the benefits of T-bills is their safety. Because they are backed by the U.S. government, they are considered one of the safest investments you can make. However, this safety comes with lower returns compared to riskier investments. Additionally, while T-bills are generally stable, their value can fluctuate if you need to sell them before maturity. This means that if you find yourself needing immediate funds, you could potentially sell at a loss, although this is rare with such short-term instruments. Finally, there are money market ETFs. These are financial instruments that follow market interest rates. They are also taxed at 26% and have a 0.2% fee on the balance at the end of the year. They are more complex and require a bit more attention, so they might not be suitable for everyone. However, they offer a good alternative for those willing to monitor the market and understand the right time to buy or sell. Money market ETFs invest in short-term, high-quality investments issued by government and corporate entities. These can include T-bills, commercial paper, and certificates of deposit, CDs. Money market ETFs provide diversification, as they spread your investment across a range of short-term instruments, reducing risk. They also offer daily liquidity, meaning you can buy or sell shares on the open market just like a stock. However, the returns on money market ETFs are closely tied to the prevailing interest rates. When interest rates are low, the returns on these ETFs will also be low. Conversely, when interest rates rise, the returns can be quite attractive. This makes them a flexible option for those who can keep an eye on market trends and adjust their holdings accordingly. Before we get to the interesting fact I promised, I invite you to like this video and subscribe to the channel if you haven't already. This will help you not miss any of our future content. Now for the interesting fact. Did you know that there are savings accounts that offer very high interest rates but require you to keep the money locked for very long periods? Some offer even 5% annually but with a 10-year lock-in period. This type of account might seem attractive, but it's important to consider whether you're willing to not touch that money for such a long time. These accounts are often marketed as high-yield savings accounts or certificates of deposit, CDs. While the interest rates are tempting, the lack of liquidity makes them unsuitable for an emergency fund. Imagine needing to access your emergency fund only to find out that you'd incur hefty penalties for early withdrawal. It's always crucial to align the terms of your investment with your financial needs. So, while long-term savings accounts can offer higher returns, they are not ideal for an emergency fund. The primary goal of an emergency fund is accessibility and safety, not high returns. Therefore, it's better to keep your emergency fund in an account where you can access it quickly and without penalties. And with that, we conclude today's episode. If you have any questions or doubts, leave a comment below. We'll see you next Sunday with a new video. Bye everyone.